Good morning, everyone. My name is Rachel DeGrand, and I help coordinate the webinars for Houston Johnson Insurance. I would like to welcome you to today's webinar, Effective Financial Management of Workers' Compensation Costs by John Templin and Jeff Fry. Today's webinar will run for the full hour. If there is time after the presentation, we will have a question and answer session. If you have a question during the webinar, please feel free to type it into the question feature and John or Jeff will address it. After the webinar is over, there will be a short survey we are hoping you can fill out for us to give feedback on the webinar and webinar topics you are interested in learning more about. Feel free to share your thoughts on LinkedIn or Facebook and tag Houseman Johnson. This webinar will be recorded and will be available on the webinar archives of our website. Each attendee will receive a follow-up email with a link to the recording and the presentation slides. This webinar is certified for HRCI and SHRM continuing education credits, which we will show at the end of the webinar. I would now like to introduce you to our presenters for today's webinar, John Templin and Jeff Fry. John Templin grew up around insurance. When he was young, his grandfather owned an insurance agency in Peoria, Illinois. Now he is the one that the clients put their trust in to protect the businesses that they've built. John enjoys making clients aware of the risks that they face and teaches them how to address those risks so that their businesses can continue to thrive. John is extremely detail-oriented when it comes to reading contracts and coverage forms and is very effective at making clients aware of unfavorable contract language in leases and construction agreements. He likes to dive in and help solve a client's problems right alongside them. Clients appreciate the way John is able to advocate for them in a way that protects their interests and respects their professional relationships. Jeff Fry has been with Houston Johnson Insurance since 2013 and became an owner in 2016. He specializes in large and unique insurance programs, primarily focusing on the construction, agriculture, and manufacturing industries. Jeff prides himself on not only providing businesses with insurance, but also educating them about it to become a true risk management partner. Jeff has a bachelor's degree in marketing and management from the University of Wisconsin-Whitewater. He has coached varsity sports for Marshall Public Schools for the past 18 years and is currently an assistant coach for their softball team. We are very thankful that Jeff and John can be with us today to share their expertise and answer all of our questions on workers' compensation. Welcome.
My name is Jeff Fry, and today we are going to discuss some ideas on how you can minimize workers' compensation costs with an emphasis on understanding and controlling your experience modifier. I am going to talk about workers' compensation claims, breaking them into three distinct parts. Number one, what to do before a claim occurs, responding to a claim, and then thirdly, what to do after a claim does occur. Before a claim occurs, we call this loss prevention. Our safety specialists would tell you to invest heavily in this area with your time, but not necessarily a lot of money, and that your organization will be rewarded for those efforts. And here is why. According to the Ohio Bureau of Workers' Compensation, 60% of Ohio's lost time injuries, where indemnity payment is made to an injured employee, the claim that occurred was actually preventable. The most common types of these claims being slips, trips, falls, and overexertion, accounting for 30% of lost time injuries in Ohio. The best part for everyone involved in the webinar today is that most of the fixes associated with these types of claims are actually inexpensive fixes and involve various types of housekeeping improvements. Things as simple as keeping walking areas clear of debris, making sure that workstations are maintained properly, requiring slip-resistant steel-toe footwear when appropriate, and things like that. Do you ever wonder why your current insurance carrier or potentially a new carrier wants to visit your facility or job site? Having a written safety program is a good start. Keeping work areas clean and free of clutter is better and helps you more. Just think about it. If you average 2 lost time injuries per year and you can prevent 60% of those claims with some simple changes, how much would you save? John Templin will cover the potential cost impact of loss injuries on your experience modifier a little later to give you a better idea. Preventing claims start with company culture and should permeate every level of the organization. Is safety ingrained in everything your company does? For instance, has anyone ever seen a sign that says things like safety first or safety is everybody's job? Those are both nice slogans, but are you living it in everything your company says, and more importantly, does? Is safety really more important than production or finishing the job on time? Most companies have written rules incorporated into their employee manual. But more importantly, what are the unwritten rules associated with your organization? Are they get the job done at all costs or else? Management is more concerned about hitting production numbers than safety, or do the unwritten rules match the written ones? Management and ownership cares about all of us, and doing our job safely is the most important thing. Hiring practices. This is an area that is often overlooked. How are you finding new employees? I know many of you would say we are finding them wherever we can, or that we simply can't find new employees that want to work. If either statement is true, then current employee retention becomes even more important. And retention is really related to hiring practices, employees feeling that they are empowered, connected to the organization, and have the potential of moving up within your organization. I was just at a conference this week where the speaker said companies were recruiting 4 employees to get 1 to show up the first day of work. And let's face it, with 3% unemployment here in Wisconsin, who you target as new employees is even more important. Some would say right now that most people that want to work are already doing so. The speaker in Florida actually mentioned targeting low-income areas where the unemployment rate was higher, but that there were employees, people that actually wanted to work, but they didn't even know how to go about it. And so targeting those types of people may be an untapped source for you. We recommend trying to track where you are getting your good employees from as well, and then trying to repeat that process. Many of our clients tell us their best source of new employee referrals come from their top current employees. Most people would not recommend someone that does not fit the culture of their employer. They don't want to be responsible for bringing somebody on that doesn't fit well. For companies with higher turnover or aggressive expansion goals, social media, including Facebook, become an integral part of the hiring process. If a potential employee fills out an application and you don't make immediate contact with them, they might have another job by the time you get around to responding. Tracking your response time and hiring success rate might be of value too. Employee training, education, and empowerment. Did you know that according to the Institute for Work and Health, that a new employee is 3 times likely to get injured in their first month of employment on a new job? This is related to training, getting to know the company, but oftentimes it is related to a person being eager to contribute and trying to do too much on the job, or something that they have not been trained or familiar with yet. So do others within your organization know that someone is new? Are they willing to help train them and teach them to be safe? We know of a company that identifies all new employees that are in their probationary period with a different colored hard hat, regardless of their years in the industry. Initially, there was pushback from the new employees, but the company started doing a better job of explaining that the purpose was to identify them to all other employees so that they could look out for them and help them return home safely to their family and loved ones after work. Once their probationary period is over, they become part of the team that is responsible for looking out for new folks that are hired as well. And so it has become part of their culture. Your initial training, onboarding, and the way you incorporate a new hire into your company culture will all be keys to eliminating or limiting injuries that occur during the first few months. If your initial training program involves having someone spend most of their time sitting and watching generic safety videos, you should probably rethink the process. Are employees all empowered at different levels within the organization? Do employees, regardless of their position, feel comfortable bringing up suggestions regarding safety, or to tell a supervisor about an unsafe condition on a job site or in the plant and feel comfortable that something will be done about it? For instance, if there's unsafe machine guarding issues, or if personal protective gear does not match the job they're being asked to do, or if there's unsafe equipment on the job site, or potentially even unsafe behavior by one of their coworkers, are they comfortable coming forward? If you can answer yes to this question, you are well on your way to having a better safety culture. Incident reporting and analysis. Are you tracking all incidents or just incidents that end up as workers' compensation claims? If you're only tracking accidents or possibly not tracking them at all, you may want to reconsider. How many times did a near miss or incident present itself as an opportunity to prevent it from ever becoming a workers' compensation claim? By looking at all incidents and making everyone in the organization aware of what almost happened in another part of the plant or on another job site, you can possibly be preventing a major workers' compensation claim. If you are tracking incidents, good for your company. Now the next question is, what are you doing with that data? If you're not utilizing it proactively, you could be missing an opportunity to lower your experience mod. You might not have the full-time safety personnel or be the size that you can dedicate someone to this important job. However, your insurance agency, like Hausman Johnson, should have people that can help and partner with the safety folks from your workers' compensation carrier to provide you this valuable service and analysis. It should serve as a starting point and an opportunity to focus on a couple of key things that will provide you the best return on your investment initially. Do you have a safety committee or a safety department? If so, how much authority do they have within your company? The folks involved in the committee and or your safety department can also help you improve your employee training for both new and existing employees by identifying repeat claims and how to avoid them. They can also help you develop daily inspection sheets for your work areas and or job sites. Are those incidents, accidents, and or workers' compensation claims part of each manager's evaluation and financial reward package? If not, you should evaluate what fits your corporate culture and incorporate some or all of these types of things into their job evaluation. If you're currently stressing production and or quality solely in the reward package, where do you think they will focus their time? It only makes sense that it would be in those areas, potentially at the expense of being safe. There are some companies that will not even allow vendors with experienced mods over 1.0 to perform work at their facilities. And you should keep that in mind as you look to expand your footprint. I work with a company that formed a safety committee and empowered them to do random weekly plant inspections, walkthroughs, and shut down lines or workstations if they found something unsafe. Once the supervisors realized that the committee had support from ownership, things started to change. Over a 4-year period, they were able to lower their experience mod by 60 basis points, saving hundreds of thousands of dollars in premium, and also receiving dividends that have netted them additionally hundreds of thousands of dollars. Not a bad return on investment for taking 10 people from different areas of the company, including line workers from each department, and empowering them to make changes. Almost all of the recommendations were related to simple housekeeping and upgrading personal protective gear, which both required minimal investment. Next, when an injury occurs. So we just wrapped up talking about trying to prevent claims, and in spite of our best efforts, a claim occurred. Now having a plan in place is crucial. The first thing to do is determine if medical treatment is necessary. If you were like me, in most cases, I would not feel qualified to make that call, nor would I want to. Many insurance carriers are moving to a nurse hotline for determining if treatment is necessary, and then if it is, the claim intake is actually done by the person on the hotline, with the employer being notified afterwards. The carriers that are doing this are telling our insurance agency that 40% or more of the calls being made into the hotline end up not being reportable workers' compensation claims. If this trend continues, you'll see more and more carriers heading this direction and pushing clients like yourself to utilize this resource. Managing that first 24 hours after an injury, including the 3 points of contact, are critical for containing costs. The 3 points are contact with the injured employee. The adjuster from the insurance carrier does this. But what about you as an employer? Are you making contact with that injured employee? Contact with the employer. Again, the adjuster from the carrier is reaching out, letting you know that there was an injury. The third contact, again, comes from the insurance carrier, and they are contacting the medical provider. But let's be proactive here again and contact them as an employer as well. Travelers Insurance has an internal statistic that shows a workers' compensation claim reported within 48 hours of when the claim occurred settled on average for 11% less than claims with greater lag times. Sooner is way better for the employer. Are you investigating each workers' compensation claim internally to determine whether you believe it is compensable and should be paid? Then the next question is, what are you doing if you question a claim? We would recommend contacting your insurance agent and carrier immediately anytime you question a claim. If you are investigating a claim, what are you doing with the information you're finding out? Are you sharing it with the rest of the organization? Are you discussing it weekly within each department? Are you doing toolbox talks? Are you being proactive? If you are, you can prevent a similar type of claim from affecting your experience mod. My next question for you is, do you know who your workers' compensation claims adjuster is? Many carriers will assign a single adjuster to handle all lost time or indemnity claims for an employer. Getting to know this person and building rapport is important in getting the best service possible from your insurance carrier. Although we are unable to direct care in Wisconsin for workers' compensation, do you have a strong relationship with the medical providers in your area? Anytime an injured employee goes to someone other than their primary physician, unless it's an emergency, it should be an automatic red flag to you as an employer and the insurance carrier as well. Have you met with the medical providers and explained what you do? The light duty is always available in what it will take to incorporate that. All medical providers should be made aware of your intent to accommodate 100% of all work restrictions within reasons. If you plan on doing post-injury or drug alcohol screening, you should consult with an attorney. You are required to comply with OSHA, and the testing cannot be deemed punitive towards an employee for reporting a work-related injury. For instance, you would be required to test all employees working with or near the injured employee, not just the employee reporting the claim. Again, though, you should consult your attorney if you're looking at doing this. After an injury occurs, so it has been determined that we are facing a compensable claim and the employee was injured at work. Trying to keep this claim as medical only now becomes critical. And how you interact with the injured employee and manage the claim will be major factors in whether the claim is medical only. I cannot emphasize enough that one of the major reasons that work comp claims linger is that an injured employee does not feel valuable or connected to the company. This makes sense because according to Louis Efron and the 6 reasons your best employees quit you, the number 2 reason an employee leaves is a lack of connection to the big picture. If your employee feels disconnected after a claim, what is their incentive to want to hurry back to work? Having their immediate supervisor, HR person, and if possible, the company president all contact the injured employee, letting them know you want them back and asking if there's anything you can do to accommodate their needs will go a long way. This has the potential to help improve employee retention, too, especially when the injured employee communicates how well they were treated through the process and the management cares about them. Having the safety committee and or safety person do a post-incident analysis to determine if the claim was in fact preventable is extremely important as well. Once a determination is made, it should be communicated within the organization as soon as possible to make sure that everyone is aware, especially if it was deemed to be in fact preventable. Do you have a formal return to work program? Are you able to accommodate light duty or offer temporary jobs outside your company? Trying to accommodate all reasonable work restrictions is an important factor in controlling your workers' compensation costs. Also, when light duty is not available, allowing one of your employees to work for a nonprofit at a cost to you can serve as an effective incentive to return to full duty. As John will discuss soon, a workers' compensation claim affects your experience modifier for 3 years. You should also be keeping track of doctors that give you issues with unreasonable work restrictions and communicating that with your insurance agent and carrier. We like to call our clients designated claims contacts a claim champion versus a claims coordinator. Their job is to be the go-to person monitoring all claims, including the reserves associated with them. Your agent should also be monitoring them too, but your champion and others within your organization will initially have a much better idea about the severity of a claim and whether it was compensable. Working with your insurance agent, you need to make sure that the carrier is closing all claims promptly. We find that more than 30% of experienced modifiers experience modifier calculations contain an error by the insurance carrier. And with that, I will turn things over to John Templin to discuss this area.
All right, thanks, Jeff. So as Jeff mentioned, I'll be going into a little bit more of the nuts and bolts to switch gears a little bit of how your workers' compensation premium gets calculated. First, we're going to start by taking a look at the factors that determine your net costs. So we'll give you a brief overview into payrolls and rates that are set by the WCRB. And again, I should slow down here to let you know that we're looking at Wisconsin-based only. Workers' compensation laws and regulations vary quite a bit from state to state. And the one thing to keep in mind is that Wisconsin is its own animal, sets its own rates, has its own structures that we'll be going over in greater detail. So we'll look at premium discounts and the workers' compensation pool a little bit. If you happen to be in the contracting business, we'll look at some premium credits you might be eligible for. There's some state surcharges that are going to go into the formula. We're not going to spend much time on those at all. We'll spend quite a bit of time going over your experience modifier, or EMR, as you'll sometimes see it referred to. And then finally, dividends are going to factor into your workers' compensation costs. They're going to vary by industry, by carrier, by your own individual history. So we're not going to talk too much about those. So to begin with, Wisconsin work comp rates. The important thing to note is that based on what you do, you're going to pay a different rate than other folks. So your employees get classified by their job duties. And at the bottom here, I've included a class code lookup for a plumbing class code that we'll use in an example a little bit later down the line. This is only the first two definitions. There are actually 28 different work definitions that fall into this plumbing class code. So what are the things that you can do to make sure that your employees are properly classified based on the work they're doing? And your agent should be able to help you out with this. If you take a look on your actual worksheet and your policy worksheets, you'll see a manual premium, which is the rate that's multiplied by $100 of payroll. And the important thing to note that Wisconsin's a little bit different from most other states in that everybody plays off of the same rates. Right? They get set annually, usually in July, go into effect the following October. Here's just a brief overview of the past 5 years of where work comp rates have trended. As you'll note, and if you've been paying attention to your work comp premiums, more than likely have seen a pretty steady decrease over the past 3 years. Contracting especially is where I spend a lot of my time, and it is at a historic low as far as these kinds of decreases year over year have never been seen since WCRB started tracking this stuff. Now they also track manufacturing, they track goods and services. There's a miscellaneous category as well that I haven't included, but this gives you a good sense of what has happened over the past 5 years. I would say what we saw in 2014 and 2015 was a lot more typical going backward as far as single-digit increases year over year. So who knows what 2019 will bring, but we'll know in July. I'm going to get into the premium discount and the work comp pool. The important thing to note is that a premium discount is basically an incentive to have a carrier want to write your business. Typically, the 5 to 10% discount off of the rates that you're supposed to be paying, according to the state. And typically, a higher premium is going to lead to a higher discount, with the idea that the larger you are, the fewer administration costs, fewer fixed administration costs there are. As some of you may have experienced, if no carrier voluntarily wants to write your business, you wind up in the work comp assigned risk pool, and you get assigned to, I believe it's one of 4 carriers now. This might be one of the only times in your life, outside of the weather today, that you don't want to be in the pool. If for that premium discount, as well as there are some service issues that you can run into there as well. So those of you who are contractors may want to perk up for these next 2 slides. I'll go over them very briefly. You may be eligible for the Wisconsin Contractor Premium Adjustment Program, or WCPAP. Should get a little postcard that comes out in usually 3 months before you've got to file for it. Long and the short is that if you've got 50% of your payroll in contracting class codes and your average hourly wage meets the definition here, for this upcoming year, you are likely eligible for a 1 to 10% premium credit based on wages paid. Other thing that's brand new this year, as Jeff was discussing, the difficulty in finding quality employees. So in order to incentivize more employers to look at apprentices, there's an apprenticeship credit program that's gone into effect this past October. So you can get either 2% of your premium back or $2,500, whichever is less. There's some carriers that have opted out, but almost everybody that I've talked to wants to be in on this and wants to be part of the solution for the construction industry going forward. And I've laid out what the guidelines are there. So if you think you may qualify, talk to your agent. All right, now we're going to get into the really fun part. It's about 9 o'clock this morning, or a little bit after, and I thought, what's better than starting with a 10-factor, really complex formula? I'm kidding. No, we're not going to go through all that. Just trust me when I tell you that, well, how your work comp experience mod gets calculated is that it's just 2 factors that get weighed against each other. The formula is going to tell you what your expected losses are based on the payrolls that you have in your class codes. And then your rates are going to change year over year. Keep that in mind as we calculate the mods going forward. And then so it weighs your expected losses against the actual losses, including any open reserves that you have on claims, as they're calculated 6 months into a policy. In short, if you have a premium that's over $7,500 in work comp alone, and you were to have the exact losses that the formula spits out, your mod would be 1.0 exactly. So to put it in simpler terms, if your mod is under 1.0, it means your loss experience is better than you might expect, and the formula expects, and you would get a premium credit. If your mod is over 1.0, your loss experience is worse than you'd expect, and it'll be a premium debit, so you'd be paying additional money in over and above the rates. Good way to think about it as you're looking at your costs year over year. Your experience mod, as Jeff has mentioned, is where you can have the greatest impact on your work comp costs. Each point on that mod is about 1% of your overall premium. So keep that in mind as you decide whether to implement the strategies that Jeff had discussed, and you'll see a huge return on that investment. So the other thing to note about an experience mod is that it's a 3-year window, and it's a rolling calculation that keeps going. So it's always going to exclude the most recent year because they're going to give any claims that have occurred within the past policy period time to develop. So for example, say your work comp policy was effective January 1st of 2019. It would include 2017, 2016, and 2015. 2018 is going to be excluded until we recalculate next year. Why is that? Well, we could have had a claim on December 31st of 2018, and we have no idea what that's going to do. So it could either be way over-reserved or way under-reserved. So it takes about a year to develop and to give us a chance to figure out where that claim's headed. The main takeaway here is that one bad claim is going to affect our experience mod for 3 years. And we'll see that as we go through a scenario momentarily. Another thing to keep in mind is what your lowest achievable mod is going to be. A question I get from some of my clients are, so why does our experience mod change every year, even when we haven't had any claims? And the answer to that is quite simply, the rates change annually, and your payrolls are going to change from year to year. You may be doing more or less business. Rather than get real in-depth here, the important thing to note is that more premium dollars that you're putting into the work comp experience mod formula is going to lower your minimum experience mod. So you might have seen over the past couple of years that you've had no claims, but your experience mod is still crept up a point or two. If you have less payroll going in, or the rate decreases, as we saw back in that trend slide, it'll increase your experience mod because there's less money that you're paying into the formula. One of the other key components that Jeff talked about and why it's so important to have that light duty and return to work program is understanding medical versus lost time claims and how that affects this formula. So in Wisconsin, there's a 3-day waiting period before you have to pay indemnity to any injured employee. If you're able to return to regular or temporary or modified duty within 3 days of an injury, there are no indemnity benefits that are due. So Peg Kramer was kind enough to throw this slide together for me. Give us a quick overview of how that might look in the case of one particular claim. So if you have no return to work, just for the sake of illustration, so you have a $1,500 medical claim. You have no return to work, and so the employee's off for 2 or 3 weeks, and you're paying them $3,500. Likely longer than that if we're looking at that kind of dollar amount. So the total claim is going to cost $5,000. That's what the carrier is paying out. $5,000, because we had an indemnity component or a lost time component, is going to go against us when they go to calculate our mod. Now, if you look on the other side, let's say we have something that we can get them back to work right away. Same $1,500 medical claim. Now we have no lost time because we're able to accommodate with light duty. The total claim amount dollars that are paid are $1,500 that the carrier is paying out. But, and this is the most important thing, we get a 70% discount on those dollars when it comes to hit us in the formula. So The exact same injury went from costing us $5,000 with not having any return to work in place versus only $450 against us in the formula by having that return to work implemented, and we know what that employee can do based on their restrictions. So now, having given you the overview, let's go through a 3-year financial impact of a claim scenario. We're going to look at just one claim, and so to do that, we're playing fast and loose with a few things, but we're going to make this a fictional Wisconsin-based plumber. It's on a guaranteed cost program. If that's all Greek to you, don't worry about it. Just assume that we're following the rules that I've set out here. We're going to assume that we've had no other work comp claims. We've simplified out class codes and payrolls versus what you would expect to see with a contractor. We're assuming no credits. We're going to keep the same payrolls over 3 years. And we're going to change the rates, though, every single year that what the actual rates were in this class code. And we're going to simplify out calculation of all the other factors. So our premium discount, we're going to assume that we're staying with a carrier that wants to write us for these 3 years. And then we're going to simplify out all that into one number. And we're not going to address dividend changes, which we may very well see. So here's our company. We'll be ABC Plumbing, LLC. So for the sake of this, just to give us a good, strong dollar amount, we started off at about $100,000 manual premium. The way we can look at it is each point on our experience mod is going to be about, call it $1,000. Right? It's about 1%. So here we have $2 billion in payroll on plumbing, about $500,000 in payroll and office clerical. So here's our claim situation. One brisk winter morning in 2015, Joe, one of our longtime employees, is hand cutting some material in the field. Gets distracted for a moment by a coworker, and his hand slips under the saw. Now, we'll start with the best case scenario, and we'll look at this over the course of 3 years. Let's say that they listen to what Jeff had to say in the first part of our presentation, have a strong safety culture. So Joe's wearing cut-resistant gloves, and he only has a minor cut on his finger. So all we've got to do is give him a Band-Aid, get him another pair of gloves, he's back to work. We'll look at a 3-year projection of what avoiding this claim has done to us. We have no dollars going against us in our experience mod formula, so we'll see what our minimum experience mod looks like over the next 3 years. So here we are in 2017, right, which is the first year that this 2015 claim is going to hit us. Remember that it's not going to hit us in 2016 because it always takes a year for that reported claim to go into the formula for us. So using the 2017 rates, we have our minimum experience mod of 0.68. We're saving $33,000 on that alone, plus staying in the voluntary market, after you factor in all the other factors, we have another $4,000 that we're getting back. So the state says based on our pure rate, we should be paying $100,000. Instead, we're paying about 60% of that. It's not bad. Now, as our rates have decreased, we'll note that even though we had a 0.68 this past year, we're now up to a 0.69 mod. What's the reason for that? We had a $4.96 rate per 100 on our plumbing payroll last year. This year we have $4.34. So even though we still have no claims, our mod is going up by a point because we're putting less money into the formula through our manual premium. Right? But again, you look at manual premium dictates, so we're getting quite a bit back from the rate, $87,000 versus $100,000. But we are still saving pretty significantly. Our work comp costs have continued to go down this year versus last. And I'll have a summary slide at the end for you. Finally, looking at 2019, what this past renewal will look like. Again, we're seeing a slight decrease in our plumbing rate, going from $434 to $425. Our manual premium is still staying at around the same rate. We still have a 0.69 experience mod, and again, we're relatively flat, relatively constant year over year. So looking at it, with no claims, here's what it looks like with a minimum mod. 0.68, 0.69, 0.69. So about $176,739 is what we're paying over 3 years with no claims affecting any of our policy periods. Now let's look at a moderate case scenario. So you listen to what Jeff had to say, but went in one ear, out the other. We did some things, we didn't do some other things. So now let's say we didn't really have that strong a safety culture in the field, but Joe's a little bit experienced. So he's not wearing his gloves, but he does have a deep cut in his hand. He's able to get an outpatient surgery, and they sew him up, they disinfect his hand. But thank goodness our safety committee already has some temporary work that can meet his restrictions. He only misses a day of work, but the total medical costs for the surgery are $10,000. Because he's been off work for less than 3 days, his lost wages don't count against us as part of the claim. It's staying medical only, so the claim total enters our experience mod at a 70% discount. So put in other terms, even though we paid $10,000, if the carrier paid $10,000, it's only going to count against us as though we're $3,000. So let's take a look at what a moderate case or what a medical only claim looks like over 3 years. So starting with around our $5 rate, exact same payrolls. We were at a 0.68 before this claim, but again, you can see a medical only claim doesn't hit us as hard. We're at a 0.70 versus a 0.68 on our experience mod. Looking at again the next year, we have the same rate decreases. Our mod goes up a point, which again, same deal, so it's because of the rates. And now we're up another point, 0.72. Again, more than likely it's a rounding issue that we were a little bit closer with the increased rates and even with payroll staying the same. So looking at our costs versus just a medical claim, $10,000 medical claim. Over 3 years, only a $6,000 difference. That's not too bad. Now, let's look at an even worse case scenario. So let's say we're all about production at ABC Plumbing in this particular case, and don't really care too much about our employees. So Joe's cut seems pretty minor. Supervisor says, that's fine, just glue it up and get back to work. We got to meet deadlines, we got to meet production. So he doesn't report the incident back to the office, and then Joe developed a treatable infection in the cut. This is a scenario I actually took from one of our claims adjusters, so if you think this couldn't happen, it certainly has. He's admitted to the hospital as a result with the infection and requires both surgery and IV antibiotics. The particular case that was shared with me, I believe the gentleman lost his hand. So we've never had an injury like this as a company, so we haven't really thought through any transitional or light duty work for him when his condition does improve. So the total medical, total lost wages, and the temporary disability costs add up to over $100,000. Because it's a lost time claim for more than 3 days, the $100,000 enters our experience mod calculation at our full amount. This is going to get ugly. So here we have $100,000, all $100,000 is hitting the experience. We're at a 0.86 when we could have been at a 0.68. We're losing $20,000 this year alone. Look at it again, we're at a 0.88 now with just this one claim. And if we have claims like this, it's likely that we might have a few others sitting out there. Again, just this claim alone has us up to a 0.88 when we could be down at a 0.69. And we're staying confident at 0.88 for this upcoming 2019 renewal. That would have been this 1-1. So looking at the difference, $50,000 over 3 years, just in some upfront claims management, and knowing what to do when an injury occurs, having a good, strong safety culture in our company. And there are also some indirect costs that we want to keep in mind when our experience mod goes up. People talk. No matter what industry you're in, you probably have a good sense of your competitors and what's going on there, because you're likely pulling from the same pool of employees, and everybody knows everybody's business to a certain extent. So you're going to have some damage to your reputation if there are some preventable injuries that are going around your shop or your job site. You might run into some OSHA inspections or citations. If the injury is serious enough, you have to report it to OSHA, and OSHA comes out, and more often than not, they will find something to write you up for. You may be ineligible to qualify or to pre-qualify for bidding work with other companies. Just keep in mind, too, when you have these claims, think about the productivity hours that we lost in our worst case scenario versus our best case scenario. We didn't even get into perhaps Joe gets an attorney involved in the worst case scenario and claims negligence against us, which is a lot more likely the higher the dollar amount you get on these claims. A track record of losses might land you in the work comp pool, and we're going to lose our premium discount. We're also going to have a little bit tougher time getting some of the services that we need out of a work comp carrier. And finally, we'll see a reduction in the dividend, which year over year could be some pretty significant savings. The way underwriters look at it is they want to see the trends, they want to see the type of operation you're running, and large losses are absolutely going to send up some red flags if we don't have a story to tell. So here are the overall takeaways that Jeff and I would like you to walk away with today. Importantly, what you do before, during, and after a claim makes a huge difference in the outcome of an injury, not only to your employee, but to your bottom line. The key apart from my portion is that you've got to keep your claims medical only if at all possible. that 70% discount and the experience mod formula can make a huge difference to us. Right, so have that light duty and return to work programs implemented and ready to go. And also, one bad claim can impact your experience mod, and as a result, your bottom line for 3 years. And as Jeff said at the beginning, we'll wrap it all up by telling you that a strong, consistent safety culture is one of your best investments. And with that, I'll turn it over to Rachel for questions.
Sure. If you do have any questions for John or Jeff based off the presentation, please go ahead and type them into the question feature here in the GoToWebinar application. While we're waiting for those questions to come in, I'll go ahead and pull up the credits for SHRM and HRCI. So our first question is, John and Jeff, how do I know my claims are being reported properly?
John, I can handle that question. What you're going to want to do is you should be receiving loss runs from your current insurance carrier. And so what you need to do is you need to compare those loss runs, and you should be getting them most likely on a quarterly basis, but you should be able to get a summary for an annual loss run, and you need to compare that to the experience mod worksheet they're receiving from the Wisconsin Workers' Compensation Bureau, making sure that those numbers match up. Like indicated before, we find that about 30% plus of experience mods contain an error. And so it is very important for you to check those.
Sure, that leads into another question, Jeff. So what happens if the value of a claim changes? Is there any way to get that corrected?
Yes. So for a correction to be made, you have to refile a unit stat card, and if a claim closes and it's at least 25% below the prior reserve level, you are entitled to a recalculation of your experience rating under what's called the aggravated inequity rule. And so, but for this to occur, the claim needs to be closed, and that's why it's very important to monitor all open claims that affect your experience mod.
All right. And we have another question. You mentioned the idea of having an injured employee work at a nonprofit company in lieu of light duty. Can you speak more to that idea?
Sure. So you can look at Goodwills or at, say, it's DePaul or at other types of, usually retail is where we tend to see this happening most often. Where they might be looking for extra hands, they might be looking for help. And if they have some light duty work available that you don't have in your shop, you can certainly work it out with those establishments in advance. Let them know, here are the sorts of work restrictions that we see typically, and you can just work with them to figure out exactly what the fit might be with an injured employee.
And this can be coordinated through your workers' compensation carrier as well. They may have some organizations in mind. One of the things that I can tell you is that employees that end up going that route for some reason have a propensity to return to work sooner because they don't seem to enjoy that work. And, you know, I don't want to say that it's a punishment, but if you don't have the light duty available yourself, or if you can't accommodate them, getting them pointed in that direction oftentimes moves up doctor's appointments, and their actual return to work is much sooner than it would have been otherwise. And so it's something that I would strongly recommend considering.
Thanks, guys. Here's another question. You mentioned refiling the unit stat card. What is the window for doing that, and how long do you have?
Sure. So let's go with an example where we had a evaluation date. Let's say the policy was from February 1st of 2018 to February 1st of 2019. The valuation date of that policy would be on the end date, which is February 1st, 2019. And you have 30 days. You can request a revised unit stat card within 30 days of the valuation date, which would be the 3/1 of 19, so when the policy ends. So you have 30 days to do that. And again, for you to do that, the claim that closes needs to have closed for 25% less.
Thank you, Jeff. Here's another question. How long does a carrier have to make a payment on a claim?
If an employee is injured, they've got 14 days from the date of injury to make a payment.
All right, and here's another question that came in. Who reports injury to work comp insurance company, the employee, the employer, or the medical treatment facility?
Ideally, it should be the employer. Should report it directly to the carrier. Again, the sooner that you get it reported, the sooner everybody can get contacted, the less likelihood of attorney involvement, which tends to raise the ultimate settlement dollars on that. So getting those procedures in place where the employee reports to one person in the office that might be the same claims champion that Jeff was talking about before, should take care of discussing with the agent and with the carrier and fill out that first report of injury.
And the other thing related to that, if you're using some type of medical hotline, nurse hotline, the nurse hotline itself will actually report the claim for you as the employer. And that is another reason that we see companies going that direction. That way the claims are reported promptly. They take the statement from the injured employee, and you don't want to leave it up to the employee to file a claim. You want to make sure that you're in the loop as the employer and taking care of that. So I think a couple more questions actually.
Sure. Sure. Related to that, how do you know if it is severe enough to report?
And that's why we see more companies going to the nurse hotline. It's very difficult for a supervisor on the line or maybe somebody in the field to make a determination if somebody should seek medical treatment. And I would recommend erring on this, being conservative and taking them to the emergency room if you're in question. If you don't have access to the nurse hotline, if you have access to the nurse hotline, I would recommend having that injured employee with the supervisor being there, make that call, and they will let you know what the next step is.
The general rule I've been given as to whether an injury is severe enough to report or not is if readily available first aid isn't able to address it, and if you do actually have to send them for treatment, that's when the report definitely needs to be made.
And can you give some more information about that nurse hotline? Is it only through the carrier, or are there other ways people can access this?
So it depends on who your current workers' compensation carrier is, whether they're offering this valuable service. And so that would be something that you'd have to address by individual carrier. And that would be something you should contact your insurance agent about and see if it's available. And they're not perfect yet. There are sometimes some glitches with them, but I think overall the potential savings is there, and it would be something that I would recommend.
Great. Thanks, Jeff. We'll leave one more minute to go ahead and type in any questions. If we aren't able to get to your questions before we wrap up the webinar, we'll be sure to reach out to you at the conclusion of the webinar. We do want to thank everyone for attending today. As a reminder, we do have a short survey at the end of the webinar, and we really hope you fill it out as your feedback is very important to us. We'd also love your feedback online if you want to go out to Google or Facebook and talk about how great John and Jeff did on this webinar today. We hope you can join us for our next webinar on March 21st on Affordable Care Act updates. You can sign up for our upcoming webinars on the Houseman-Johnson.com website. And we thank you for attending and have a great rest of your morning.